All right. Good morning, everybody. We've been waiting for this day all week, and we finally got it. The market did a reasonably decent job of just trying to hold the line. Small caps up 1.5%. Could see a little bit more out of Bitcoin and maybe short covering, some little bit of short covering rally. Japan up, NASDAQ more than 1%, S&P close to 1%. Those numbers look good, but after the move yesterday, it seems a lot of it is just a rebalance back in the other direction. We're not going anywhere. We haven't gone anywhere. Dow down or up, but down more than the others. Should say up less than the others. That makes more sense. Still less than 0.75%. And then Hong Kong basically flat. So your China ADRs aren't getting any love. The Baba, Baidu, JD crowd. This PCE data is the big one. It's what we've been waiting on. Monday, we're going to get the start of QRA. It's a two-part event. We'll get the first part Monday afternoon and the second part Wednesday morning, and then FOMC Wednesday afternoon. So next week's going to be a big one. There's this phrase that the FOMC is volatility suppressing. And I get it. At first glance, you hear that and you think, no way, man. Have you seen the market move when FOMC comes out? That's the very definition of volatility. But leading up into the event, the week of such a big event, it's volatility suppressing. We expect the market to go sideways and wait. The thing is, next week's not your typical everyday FOMC. It's lining up with the QRA. So if you play some sort of hurry up and wait, mean reverting sideways strategy on Monday and Tuesday, thinking we're not going to really move much until Wednesday FOMC, I would caution you against that. I'm not saying we're going to make a move, just that we're going to get data Monday that can move us, irregardless of waiting for FOMC or not. So approach that strategy with caution. For today, it's just PCE. It is the thing. Everything is going to respond and react from this. So anything that's up or that's down likely will change direction depending on how the numbers go. So there's no reason to dig too deep into the names that are gapped up or gapped down, other than things like penny stocks or things that have earnings, because those are event-driven moves that have no bearing or basis point on the basket of stocks that we track on a day-to-day basis, right? Good times, baby. Seems like there was some vandalism over in Europe to the rail lines, and that might screw up the Olympics a little bit. There was already a start to some of the play for the Olympics, like was it Bristol Myers and Nike, a couple other names that were expected to get a little bit of a boost or benefit, may now not get that boost or benefit, or at least have a little bit of a negative impact. Then there was the rally in Bitcoin connected to the Bitcoin event this week. I grabbed some really cheap stuff, just anticipating the move, and figure I'll just hedge it and roll out if it isn't working. But so far it seems to be all right. Bitcoin's up considerably this morning. I think 3% was the last I seen it. Yesterday we talked about this white dotted line, and it's an anchored VWAP for the start of May. And I don't put a lot of weight into these anchored VWAPs when it comes to the futures. I just really haven't seen much in the way of value there. But I gotta say, in this current run, when we came into contact with the July weighted VWAP, it held the line for at least a day. We cut right through the the June, but we did hold the line on that one, at least for the moment. Knowing where those levels are at certainly helps, right? And it lined up with 54.32 cog line. So, we'll take it. Yesterday, the anticipation was that we could dip a little bit lower and then get like some sort of V bottom and run back up, and that we would need to break through our own Globex low and make a run. And I did warn, be careful with this zone right here, because it would be difficult to get through. And it was. That's where we stalled out and really had a hard time getting through that level. We did finally make it though. That's the important part. Ran all the way up to R1. If you aren't carrying those levels on a day-to-day basis, you're doing yourself a disservice. It's not to say that we want to trade them levels like there's some, entry and exit points. That's not really what I'm saying. You definitely want to know where they're at, right? So that if you were, say, trying to trade long on the breakout, you at least knew that there was a level up there of interest and concern that you might hit it, and it would stop the long trade. We're still underneath last week's close. You can see the level here, 55.52. And we did something yesterday, and it was a really great question. Somebody asked me, how many times, or is it even possible that we can go from one ADR line red to the other ADR line red, and then back again to the previous ADR line? And has it happened before? I thought for sure it had happened already this year on the ES, but I went back and looked and I couldn't find one for this year where we did it. Maybe I'm thinking of the NASDAQ, or maybe I'm thinking of a near miss, right? Like I thought maybe we had done it and we didn't, but we sure did it yesterday. From the lower edge back to the upper edge, back down to the lower edge. And those are some big moves, right? Absolutely some big moves. A little bit of a tell for when everything just shut off yesterday and started to turn and go the other direction. This is the weighted AD, and this is cumulative tick. And you can see where both of these changed direction. Now, the weighted AD, generally, if it's above 250, then I consider a long opportunity still on the table. But when we were at 500 and it started to roll over and move sharply lower, that was a good signal that things were struggling at that high. Then you got the green line crossing over, trying to get to the bottom of the group to lead us lower. It didn't necessarily make it all the way down there, but you just see how everything changed here. And kind of back that up with the ticks. We had that last hurrah, the run up. Kind of match that with price. You had your last run up on the day. And this thing does a good job usually of anticipating where a market move will stall when we get into that 1,000 level. So that if we're driving hard to the upside and you get a plus 1,000 print, you're about to stall. This overshot a little bit, at least on the NASDAQ it did. It made it up just a little bit more. But after that, we started getting lower highs and lower lows and dropped down into the red, and we were really struggling at that point. So we had a lot of signals that the run up was done, even if we didn't necessarily have short signals from what I'm showing you. They were good warnings that the long was done. We have a market maker move this morning, by the way. they're hedging, as we would expect them to, because they're concerned. The ADR levels were really close to our own VWAP. We really haven't ran too far away from it this morning, so it's keeping up pretty easy. We're above the ADR red half, which implies that we could go to the upper ADR line, except we have PCE this morning. And that lines us up for a gap close play. So I know, I get it, you don't see a gap. And I've gone through these enough that I think most people have probably seen this, but we'll just do it again anyways. It doesn't take long. This is the play that I want to have today. And we get this opportunity with non-farm payrolls, CPI, PPI, and PCE. There's a couple others where we get this chance. And this setup can happen on the intraday too. It doesn't need an economic event. Any large candle like this that happens very fast is what we would consider a gap. It's a gap in liquidity, not a gap in price. When this gap happens, we expect it to be filled. I want very clean gaps. I have a very specific trade setup, and this is exactly what it looks like. We don't want a lot of wick going in the other direction, and we want it to close near the end of the move. Just a single directional shot. It sat down here and based a little bit. It got the gap closed around 11 o'clock. So, you know, one candle, one picture, one time, maybe it's just a coincidence, but here's a different one going in the other direction. It's an 8:30 print economic event. No real move to the downside here. Closed near the upper end. It didn't really base up here this time, but it did start working on that gap close. It got there around 10:30. It's another one. This is a CPI one. Looks a little bit different because we got the first initial move and then it pulled back a little bit. The next candle consolidated within that range. It stayed within the zone. Basically, it stayed within that wick. Then the next one continued the move. Then we finally started to build a base. Got back down there between 10:45 and 11 o'clock. Got the gap closed. We have this potential setup today. Don't know for sure that we're even going to get the setup, but it's on the table. This is what we don't want to see. We don't want to see price fall back away. We don't want to see a move in the other direction before the initial drive. And we don't want to close anywhere near the midpoint. If we were to take this candle and divide it into 4 pieces, like a dollar into 4 quarters, then you got your midpoint, then your 75 and your 25. We don't want it to close below the 75 mark. So if it doesn't close in this upper zone at all, there's no gap close play for me. I'll just trade something else. It's not a big deal. We also don't want it to get the gap closed very fast. I don't like trading between 8 and say 9:45, 10 o'clock. So, you know, even on these gap close plays that worked out really good, I want them to kind of build that base across the top or the bottom. Give me some time into the regular trading session to play it so that I don't have to play it in the pre-market. This is another one of what we don't want to see, big wicks on each side. That's not what we're looking for. Plus, we came right back to where we started already. What gap is there to close if we've already come back to where the candle started? So it's not what we want. Another example of what we don't want. And another example of what we don't want. Now, I get it. Look, even if you don't want to trade the gap close play, I'm not saying you have to, but at the very least, if I can stop you from thinking that this is a really great long and that you don't try to buy SPY calls at the open because we had this really big bullish print, then at least I saved you from doing that, right? Same thing if it's a big negative move, that you don't run out there at the open and try buying a bunch of puts thinking we're going down on the day. If I can save you from that, then, you know, great. We'll just call that a win. I did mention that this can happen on the intraday too. So here's a 10 a.m. economic event. We got the really large candle for the gap. That gap has been created. Later in the day, we got another big gap. That one was filled within 15 minutes. Then we got another one here, which sent us to the downside, closed the original gap, and we ran back up and we closed that gap. A lot of gaps that day. These things happen all over the place. So, there's nothing special about today. It's just that we have an opportunity for this setup, and I like to play this setup. As for which direction the market's going to go today and how far could we move, well, we need the data first, right? Without the data, we don't have a clear guidance on if we're going to stay bullish or bearish. So here's the pivot points. Central pivot of today is relatively the same size as it was yesterday. We're looking for a really skinny, narrow channel. So narrow that you can't even see the channel at all. All you see is the purple line. That is so narrow that the channel is basically not even there at all. A wide channel implies that if we break out, it likely doesn't stick. Like yesterday when we tried to break down even more, it didn't stick. We tried to break out, we just really didn't get anywhere. But a narrow channel implies that if we do break out, that it does stick and we can continue to move in the direction of the breakout. Wow, the founder's note just came out. Right on. We got the AM note. I haven't had time to go through it yet, obviously, but I'll get it shared here in a minute. We're still considerably distant from the weekly pivot point. And I mentioned yesterday, we were just about as far as I expected it to go, that we could go a little bit further, but then we would very likely run back the other direction. So we just can't get too far away from that weekly pivot point. Since the weekly pivot won't change until the end of the week, our distance of how far we could get from it also won't change till the end of the week. So, on a normal basis, each day the floor pivot moves with us, how far away we can get. Same with the 10, it moves with us every day, but this ain't moving. It won't move. I have seen once we've set a distance like this, a limit away, I have seen it get tested and we try to go a little bit farther away from that pivot, but the move fails. So while this low could be tested and we could see a deeper low from here, it's the same number as yesterday, 54.11. I don't see any way that we can get past that, even with negative PCE numbers today. I don't see how we could get past it today. Now, next week, well, that's a whole different conversation. The floor pivot today is not just lower than yesterday's. We opened lower than the floor pivot too. So there is that from a central pivot perspective, that's bearish. They're hedging, but they're also trading. Generally, when we see a market maker move, we get volumes in the 30s, 40s, maybe the 50s. We've got volume in the 95 area, and we've got the market maker move. So they're doing both. They're hedging because they're concerned, right? That's why they hedging is insurance. It's cost. Unlike for retail traders, a lot of times we can put a hedge on that's basically just a trade, and we can minimize the loss and just use it as a profit mechanism. For them, it's totally cost. And just imagine, taking a bunch of money and throwing it in the fire because it's cost. You're not getting it back. It's not some profit play where it could turn out in your favor and you make a gold mine. And they're only going to spend that money if they're concerned. This pullback so far has only reached 5%. The typical pullback is 5 to 7%. So we're at the most minimum amount that it could be. And I still contend that it could go farther than this. It doesn't mean that it has to, but it could, right? We're lining right up with a pullback into QRA and FOMC. My take on it is we need a pullback, right? So that we can stay healthy and we don't get a market that's going parabolic. We get this good, healthy pullback. We get QRA, FOMC, and then we have the opportunity to make another leg higher. Even if we don't make another leg higher, we could just sit here and chop for the rest of the year and even into next year, with a low, say, of 51 or even 5,000 and the high of 57 and that 700-point range for the next couple of months. Doesn't sound very fun, that's for sure. A lot of trash to the upside. We have the 10-week moving average here. We talk about it every day. So we're back above it. But we have the 3-week, the 10-day, the 20-day, Friday's close, yesterday's high. And speaking of yesterday's high, the entire day of yesterday can be measured, quantified, mark out our 50% mark, right? Get that half back level. It's 83. So we're back above the half since we're at 86. But you can see that 50-period moving average over our head, and the round number 5,500 is going to be a significant level to get through as well. You can see that's where we fought yesterday. It was a part of that pullback. Nice little 3-bar reversal play. And it lined up with Wednesday's level, where I had warned you guys, watch this area from Wednesday because it was going to be difficult to get through. So we got to get through that again today, if we can even get through it. The market maker move this morning is at 1717, which equates to a 40-point move higher or lower. We've got a daily expected move here of 49, a 1 standard deviation move of 59, and a 21-day average daily range of 61. Now you could add those 3 numbers, 4 if you take the one on the trade tab. Add all 4 of those together and divide by 4, and then apply the market maker move to it. Or you could just take that yellow line from the ADR and apply the market maker move to it. It's another 30, just call it 32 points. So from 55, add 32, that's 55, 32. Put the 7 on there. 55, 39. That's higher than yesterday, and it gets us into the 3-week. Not by much, and we'd still be underneath the 10-day, but we would get outside of yesterday's range using the market maker move. Same thing to the downside. Take off 32, That'd get us into 52. And then take off those 5 points there. So 47, 53, 47 to the downside. I might have messed those numbers up a little. It might be 53, 52-ish, right around there. Either way, it's still above this red line, which I'm going to believe is the put wall. We got to pull it over to see. It's a spot gamma level. Yeah. No, we're looking at way down here. That would be way below the put wall. If we break below that put wall, it's game on to the downside. We're talking flash crash metrics. That number needs updated anyways. Hold on. Aha. 53.44 is the put wall now. It rolled down. So the flash crash seems much farther away now, right? When it was at yesterday's low, well, breaking yesterday low would be a pretty easy thing to do and really put a flash crash front and center. But now it's down at 53.44. We'd have to get below that to really start to witness some sort of threat of a crash like that, a flash crash. And that's 100 points lower than this than the low of yesterday, basically, just using some round numbers. Yeah, but I like it when they just say, I don't know. Don't blow smoke at me. If you don't know, just tell me you don't know. And I was kind of comfortable with that. It's I like that. Seems we don't hear it enough where people just admit, I don't know. I don't know, man. 10-day, 30-minute volume profile. It shouldn't be surprising though. In front of big data, if the number is muddy and the options are muddy, and it is, because this is so much stuff wrapped up all together. FOMC, QRA, PCE, all of it all just jumbled together. Too many competing interests and too much of we need the data to make a decision. And so there's no positioning because they're not going to position in front of what they don't know. And if there's no positioning, there's no option metrics to read. And then there's just the 0-day noise. And it's all just muddy water. Speaking of muddy water, this 10-day, 30-minute profile has no historic perspective to it from like a pattern other than a D shape, maybe as a distribution shape, that it's equally trash across the board. It's not like we've got it sitting at the top where we'd have an upper P or sitting at the bottom where we'd have a lower B. It's just a mess. And we got high volume nodes all over the place. We are building out some structure down here if it sticks, but there's no reason that it should, unless we're just going to sit down here until Wednesday, which I find hard to believe with QRA Monday likely to break this zone and move us in one direction or another. The main takeaway is that since we're not sitting in one particular spot and holding for any data, this point of control isn't likely to move anytime soon. We have at least another week of it at this level, at least. And that 5,600 is a significant line in the sand. We don't have a new VPOC from yesterday. We've crossed through that zone multiple times. We don't even have a good profile from yesterday, unless we were just to call it that D shape again. High volume node, we're already interacting with it, and it's where we've built out today's point of control. And we have the yeah, sorry about that. Then we have the other profile here showing a point of control in the lower edge. So with TPO down here showing this is where the greatest amount of trading took place at that number. This is trades by time. This is trades by price, right? Time, price, opportunity, TPO. So we're going to look for these 2 points of control to sync up. Very likely this point of control will move up to this location. The value area high will shift up a little bit at that point, but hasn't happened yet. Three levels or 3 days, Wednesday, today, yesterday. This is our zone. And it very likely could hold as our zone all the way into next week's FOMC. I just find it really hard to believe that that's what we're going to get. If the numbers that Janet proposes Monday throws everybody off, then, I mean, yeah, we could just sit here and chop sideways. And I believe we're going for status quo, right? No big change. And if it's no big change, then we could just sit and wait for FOMC. We have next week's range already projected. It's not set in stone yet. It won't lock until after the close today. So throughout the day today, it's going to continue to move up and down, but it does give us a little bit of a forecast for next week. This is the week that we just had. So one thing I like to do on Fridays is lay it on to next week's range and look at the size of that range. Is it bigger than our range or smaller than our range? These ranges are derived by volatility and time. Well, the time doesn't change. We have 5 days next week. We have 5 days this week. So that's the same. The only other number or metric that changed then is the volatility. If volatility is lower next week, the range would be smaller. If volatility is greater next week, the range would be bigger. FOMC is supposed to be a volatility suppressor. We would expect the range next week to be a little smaller. It's not. If I zoom in, it's actually a little bit bigger, but being zoomed out like this, they look comparably about the same. That the week we had this week and the week we're expecting next week have about the same amount of volatility. Close enough that we'd have to zoom to even see the difference. Maybe by the end of today, this range will have shrunk some or it will have grown bigger. But at the moment, next week's looking a lot like this week in terms of volatility. We're at the 10-week. And from this point, it's like being in the center of the basketball court. We could make a move in either direction, a good 2.5% to 3% move up or down from here. What we've been doing mostly since 2023 is staying above the 10. That's generally what we do. You can see in 2022, that bear market year, we spent most of the time underneath the 10. But since then, we really haven't had, continued drives under the 10 for long periods of time. Halfway through this quarter and through into the next quarter. So it was about a quarter of time. It just happened in the middle of one quarter to the next. We had some weakness. August, September, October. Then we came out of it in the November QRA and we ran. Well, here we are again, July, August, September, October. You know, we're back into that time frame. It could happen again. It was late July and then into early August. Well, hey, look at that. Late July and into August. Things just repeat, right? As for our distance from the 10-day rather than the 10-week, we're at little over 1%, so we're on our way back up. Just be mindful that it can go back down again before it even gets to the 0 mark. We've seen periods of time where we were working our way back towards 0, and before we even got there, it turned around and went deeper again before coming back out. So just because we're on our way back up now doesn't mean we're going to get to the 10 first before we say head back down. Semiconductors are up, SOXL anyways. It's a 3X semiconductor ETF. They were down more than 20%. So being up plus 6.5 still has them down in the last 5 days, more than 15%. Same with the FANGs or the FANG up group. I got a FANG up and a FANG down, so this is only tracking the upside. It's up more than 4.25, but it's still down more than 12% over the last 5 days. That's some mean reversion stuff right there, right? It's a knee-jerk reaction, dead cat bounce, least squared methods, dot plot statistics sort of stuff. That isn't bullish. Bitcoin is up 4%, 4.25, but over a 5-day period, they're still down more than 4%. SMH, another semiconductor, was down almost 7% over the last 5 days. They're up 2.25 this morning, but again, that's not bullish yet. That's more mean reversion. Solar, gold miners, banks, uranium. It may have just been easier to look at what isn't up this morning. The financials, banks are up, but XLF is down. When we just say financials, it's so generic, right? Trading desks, credit cards, lending institutions, insurance companies, all of that fits under financials, which is way more than just saying banks. So banks are up. Finance is not up enough. The FANG down is down. It's what we'd expect if we have FANG up being up. It's FNGD and FNGU. They make a good pair ratio symbol too when you put those two together. Nat gas down. Man, that's it. We got nothing. Nat gas. Even crude is down a little, but it's not down enough to meet our qualifications. So with Bitcoin getting that, they had the 3-day conference, they're getting some attention. Some Bitcoin plays like Riot, Mara. I know Mara's up this morning a bit. Riot's up more than 6.5, and Mara's up 6%. MSTR 5.25, Coin 5%. So you got those in play at the moment. NVIDIA more than 2.75. AMD close to 2%. TSM, Square, PayPal. Well, not Square. Leave that one out. So we do have that group. Pot stocks. They've been trash. If they're up today, we're just talking, day trade stuff, not swing. And uranium's been a bleed down to these lows. We're below the open of the year, and we're certainly below that anchored VWAP. If it's going to hold and flip, I would expect it to happen here. We could overshoot that low and get just a little bit lower, but we're not expecting, like some massive sell-off in uranium like 2022 and 2023. We're not expecting that. Doesn't mean it can't happen, but that hasn't been the play. So for this semiconductor setup, we got to get outside of yesterday's range. If we can get that inside day breakout, then challenge this day here. It's July 24th. You got the midpoint there. Get that midpoint out of the way. This is a very strong TRB, but it would take a lot to get back up there. What's more likely and what has been the target is coming down to this anchored VWAP 220. All we're looking at here, as far as I can tell, is that we dropped, we bounced up like a dead cat bounce and down, and we're bouncing up a little bit. You see what I mean? It's just working its way down. So we bounced on some form of support. We're looking for a rally up into resistance, and then the rollover down to the next target. Keep breaking the previous low. Got about 15 minutes for the data. Say get lined up for that. Didn't really seem like we had too much in the afternoon to worry about. These net positions shouldn't cause too much of an issue. The rig count really doesn't change much. After 10 o'clock, this inflation expectation data at 10, that should be the last of it. And then we can just roll it out into the close. Be mindful, Yellen doesn't show up in here all the time, right? She'll be out chipping teeth, especially with the Fed in blackout mode, because she doesn't have to share media space with them, and she can get her piece said and covered without having to share the limelight. So watch out for anything you see that has Yellen in the name, because if she's giving any hints on QRA, well, that helped line us up for next week. All right. Otherwise, be careful and enjoy your weekend. I'll see y'all Monday.